Before I introduce our panel, I wanted to kind of contextualize the discussion we'll be having today. So for those of you who don't know, in the first 2 months of this year, we at Fintel Connect commissioned a report done by Cornerstone Advisors that surveyed 126 senior execs at U.S. banks and credit unions, and we asked them about their marketing spend and about their marketing performance. What was found was that the marketing execs struggled with connecting their marketing spend to measurable outcomes, largely due to attribution limitations. Now, despite that, this marketing ROI gap, the marketing folks were still allocating dollars heavily anyways to channels with muddy measurement and even to those with lower rated ROI than other channels. So today, we will be diving into why marketing teams struggle to identify which channels are driving real growth, what signals to look out for or avoid, and how institutions can go about making smarter decisions about where their growth dollars go. And we have a great group of panelists that can speak to that today. I'll introduce myself. I'm Danielle. I work closely with our clients on growth and strategy here at Fintel Connect. Fintel Connect is an affiliate marketing solution dedicated to the financial services space, and we help scale customer acquisition through partner marketing for U.S. and Canadian banks, credit unions, FIs. Enough about me. I am joined by brilliant industry vets here. We've got John, Amanda, and Carlos that will be driving the discussion today. I invite you all three to introduce yourself and tell us how you connect to the topic. Does someone want to go first? I will nominate Amanda.
No problem. Thanks, Danielle. Thanks for having me. Hi, everyone. I'm Amanda Scher, and I am the VP of Affiliates here at Pagaya. If you don't know what Pagaya is or have never heard of Pagaya, our mission here is actually fairly simple. We expand access to credit for consumers by working with our bank and lending partners to level up their underwriting with our AI modeling and to strengthen their customer relationships through performance marketing channels. In my role specifically here, I focus on helping and collaborating with our partners in order to execute, build, and continue to optimize powerful affiliate strategies to scale both of our businesses.
Thank you, Danielle. Thanks for having me. I'm the founder at New Market Growth. New Market Growth is an agency that helps credit card issuers and personal loan providers scale within affiliate channels like Credit Karma, Experian, LendingTree, and the like. I also publish a newsletter called The Free Toaster. It goes out every Wednesday, and we talk about growth, marketing, acquisitions, the intersection of marketing and credit, things like that. And then prior to those two things, I was an executive at Credit Karma for 4 years, and I was an analyst at Capital One for 7. So been in and around lending and marketing for about 20 years now.
All right, that leaves it to me. I think my name's John Hanley. I'm Executive Vice President, Chief Marketing Officer for Idaho First Bank and Peak Bank. And Peak Bank is our digital first brand, national deposit marketing channel. And been at this role for 2 years. Prior to that, I was CMO for another community bank for about 12 years. I've been in the financial industry for about 20 years, give or take, and have worked to implement digital strategies from the second I got in the door. So thrilled to be chatting about ROI and all of the other measurements that banks look to today. Thanks, Danielle.
So to kick us off, many financial institutions still trust the legacy channels that look best in reporting. Where do you see the biggest disconnect between reported performance and real business impact?
I think one of the couple things in terms of disconnect is, as a CMO, we often assume that when we can boil down campaigns, whether it's a blended digital plus traditional, into some sort of ROI, like 177% ROI might sound great to all of us in the room who are marketers. But the reality is you're presenting or pitching or talking to banking leaders who do not think in those terms at all. And I know there's some community bankers on the line here who are like, yes, I agree. A couple of the things that came out of the report that I think we're referring to is it's not so much that CMOs need to measure more or present more mounds of data to our clients, we've got to figure out how to connect the story with what they see and what they learn and what they believe in. And so what I often advise people working for me or other marketers to do is to make sure that don't assume that ROI is going to tell your full story of campaign. The reality is your clients are valuing different things. And for some banks, it may be, deposit growth net. For some banks, it may be new customers in the door. For some banks, it may be customer acquisition cost per end user. And as a marketer, it's your job to figure out what that is. And you can only do that by asking diligent questions in your meetings with them and not assuming that whatever you present or pitch or show is going to demonstrate your own success. And so one of the things I've had that I took away from the report Fintel did was just that in relation to paid search. And a lot of times paid search gets approved because it's easy and relatively cheap, but it can often be the hardest thing for bank marketers to connect to real success. So again, just working with your clients and identifying what their key goals are is of paramount importance to what you do as a marketing leader.
Yeah, and appealing to the business objectives, maybe not necessarily the exec that you're trying to please either. Yeah. To the group, what is one metric that looks useful on a dashboard but can be misleading when making budget decisions?
I can go. One of the things that I always see is really around return on ad spend, to kind of tie to what John was saying with paid search campaigns. Like those type of campaigns, you can really optimize the top of the funnel, right? You can bring in a lot of leads with a campaign like that. But if you're not aligning that campaign to the risk criteria that your strategy is trying to drive and bring in, it's going to be a really expensive trap to fall into. In the past, I've seen teams on a daily basis or a weekly basis, as they're giving updates, they're touting these very high lead numbers they're bringing in. Look at all these applications we've brought in. Our cost per lead has gone down X%. There's these huge spikes from the campaign, right? But what happens then sometimes is if you haven't tied that campaign to your actual underwriting criteria to drive the right people through, your campaign significantly underperforms. So your audience is going to get declined by your risk strategy. You're not going to hit the bottom line number. So your unit economics significantly drops. And so while that top of funnel, that cost per lead number is really great, your actual return on the spend you did could actually be net negative. Like at Pagaya, we really monitor our performance by channel, by source. We're really, really diligent and get into the minutia of it because we are focused on that bottom line, sometimes at the expense of the application volume. So those ideas that you're seeing really big jumps and that lead number is going up kind of trips you up at times because that revenue doesn't come up. And so it actually flops the campaigns that you're doing.
How do you scale then? If you have the pressure to deliver faster, more at the quality, they like the quality that you've now driven. How do you balance those two things if they're seemingly at odds with one another?
I think that is a great question. I think what you need to figure out is, one, is there a ceiling for that channel too? Like, is there a max that you can really get? But also, how do other channels or other partners play into that channel? I know we'll probably talk about attribution in a bit, but they aren't all for just driving the actual conversion. The channels all speak to one another, and it's about when is that consumer working and leveraging that channel. Their intention might be different. And so you might find that you max out in that channel that's really driving the conversion, but how do you translate the extra to amp up that channel by letting the other channels attribute to it?
Does anyone else have a metric that they think looks useful but can be misleading?
Yeah, I'll add one. It's CPA, or cost per acquisition. So the trap I sometimes see is and this sometimes comes from like financial teams, maybe like the CFO's office, where there's an impetus to drive down CPA at all costs. And I think that's a really dangerous one. I'll give just two examples where I see this often in affiliates where sometimes a lender just, for whatever reason, gets stuck in their head they need to drive down CAC 30%. And in many channels, you're able to negotiate your CPA to virtually anything. The thing is that there's consequences to all of that. The publisher will change your ranking. The publisher will change how your offer is placed. And that could have two really negative consequences. One is your volume will come down materially. Two, and this is the really scary one, is the quality of the audience that comes in can change. So when you were expecting maybe a 5% loss rate, that can be 8 or 9 or 10% because now the audience you're attracting is negatively selected. So trying to optimize for CPA in a vacuum, I think, is really, really dangerous until you think really about like the all-in impact of changes like that. And net in affiliate, I've actually seen it's best to like be towards the higher side of the market, like maybe somewhere on like the 25th percentile. You don't want to be the most, you don't want to be the highest, but you definitely don't want to be the lowest. That's been my experience.
Carlos is so right on the CPA because, our management financial suites often think, well, if, I can compete on rate or I can just, pay a little bit more in the marketing funnel to get leads. And it doesn't totally work like that. We've had months where our CPA looks great and they've been some of the most horrible months in terms of deposit growth or deposit retention that we've seen in our franchise. And conversely, the media mix is important too, because if you're modeling affiliate channels plus AdWords, performance, social, et cetera, I've certainly had meetings where you walk in and you've got a junior accounting analyst there, and they said, "Well, hey, John, I looked at your average Google Ads CPA, and it was over $1,000, and affiliate was $100," and you're like, "It's not apples to apples across either," like Amanda was saying. And so, making sure you audit your full customer journey in terms of attribution and even funnel is critical, and perhaps even more so than what you measure totally from a key metric standpoint.
At risk of maybe jumping the gun of some of the questions we have, it begs the question, what is maybe a better metric then, if not CPA? Or maybe the answer, Carlos, like you said, is definitely don't measure it in a vacuum. But how do we work with that metric, because it is a good one, but it's the story that it tells in tandem with other metrics. Does anyone have a? I mean, I will actually offer up one. CPA is works well in tandem with in deposit land CP10K, right? So I, as a banker that I am not, am willing to obviously spend more to acquire the customer if the balance is significantly higher than the next customer that comes through the door. So measuring the acquisition cost against the amount of deposits that was brought in is a much healthier way of leveling out that CPA. Sticker shock. Is there anything else that the group would mention here?
I think that's just it. It's got to be taken in tandem with other performance metrics that you're willing to cite and review. And one I often use just to check myself before I wreck myself is marketing spend ratio. But that isn't even totally that can be manipulated pretty easily by market, by ad spend, by what have you. But it's usually what my team uses to gauge whether, okay, this is a reasonable allocation of resource based on what we're going to get at 30 days, 90 days. And the time horizon combined with CPA is often, your biggest hurdle to getting understanding from bank management who thinks in quarters, who thinks in months. And sometimes the reality is you're trying to acquire a customer for a set life cycle. Now, maybe 6 years, it may be 11 years, it may be 1. And the push and pull between what that return on the marketing spend is may not be adequate at even 6 months to articulate. And so you've got to be prepared to explain the limitations of some of the metrics to do that.
One thing I'd add to what John just said, at least in the lending world, I think I happen to think the marketer in a lending context is one of the hardest jobs out there. I'm not just saying that because I'm one of them. I'll explain. It's because in a lot of other marketing contexts, you kind of know whether you won or lost within days of the campaign. You ship the campaign, you're either, you know your CAC, you know how many units sold, and you can declare victory or not. In lending, it takes years after that vintage came in to really know whether or not you did a good job. So any dashboard that I see in lending that doesn't have a lot of credit dimensions, early delinquencies, early losses, model predictions, things like that, I think is fundamentally incomplete, because your job as a marketer is so deeply connected to credit that you have to be looking at both things. So your question's a good one, but I don't think there's a simple answer, because like you're probably looking at 10 to 20 metrics, and you're also looking at them for a pretty decent span of time. Yeah.
Which I think was part of the report, right? If the time horizon has to be greater than 6 months, and you're allocating budgets in quarters, or your planning cycle is structurally at odds with getting the right answers. I think that's really what the report was trying to say. Okay, so Carlos, from the lending side, where have you seen teams mistake lead volume for actual growth? Can you share an example of what looked really strong on paper but fell apart when you looked a little bit deeper and you started really digging into the 10 to 20 metrics?
Yeah. This one actually only required a few metrics to see the problem. So we this was an affiliate marketing example where we turned on a new publisher, and the structure of this deal was we were paying per lead. So no CPA, we were paying per lead, and very quickly, within days of the program coming on, I think the total lead volume of our entire program was up like 50% or 100%. Like you could see the meaningful pop in all the top line dashboards. And without knowing anything, I knew it was too good to be true. I just didn't know why, so I started paying attention. And then as I dug in, one of the differences was we were buying shared leads. So from most of our other publishers, we were buying like sole custody of the lead. In this context, from this particular publisher, the publisher was selling the lead to like 15 other lenders. So that was one thing. So all right out of the gate, you can see the conversion rate is going to be different. But in the context I was in, if we didn't dial the lead quickly, we weren't going to get access to that lead. And we weren't dialing quickly. So I already knew that our conversion rate was going to be off. Long story short, this was the highest CAC channel we had. Within weeks, it was the highest CAC, lowest conversion rate. And to make matters worse, our CAC wasn't even factoring in all the soft inquiries we were doing to qualify these leads. And when you factored that in, it just made the channel like toxic. So because we were paying the bureaus an ungodly sum of money to evaluate leads that we weren't calling quickly enough and had no hope of closing. So we had to really shut down that channel and reevaluate it, given all these dynamics. So the cautionary tale is when you see lead volumes blow up on your dashboard and you can't fully understand why, dig, because there's usually the story isn't as rosy as it looks. At least that's been my experience.
Yeah, I experienced something similar. A couple of years ago, there was a channel with an affiliate where we were all of a sudden overnight, we saw this huge jump in volume, like thousands of leads a day. And that's great from a marketing perspective, right? As the marketer and the owner of that campaign, I'm like, great, look at what we're doing. But approval rate was more than cut in half. I had credit asking me like, what happened? What did you do? What's different? And within a couple of days, we realized that affiliate partner had changed their strategy. What are they showing to the consumer? What's their space looking like? And so they changed how they were engaging with the consumers coming to their site. And we, at my previous company, weren't ready for that strategy. So we were getting a totally different quality of consumer coming through, which then completely trickled down to the bottom of like, even the people that we were, getting to convert, they weren't who we really wanted to convert, which meant the returns were going to change, the performance was going to change. So it can happen without you even knowing it and without you doing anything yourself.
So what I'm hearing is be healthily skeptical when something is too good to be true. It probably is. And you have got to be eyes glued to your dashboard at all times. Very good. Okay, John, from a bank growth perspective, where can performance-based channels help institutions reduce guesswork and make growth decisions with more accountability?
Yeah, I think when you think about the life cycle of a bank marketer, you like Carlos said, you're determining the success of your campaigns pretty quickly after launch, especially if you're going after deposits or lead generation. And that's been a change over the last probably 10 to 15 years. That's really been great for the CMO is that you kind of know within days or sometimes even hours if your campaign creative and materials landed, because you do start to see those performance channels work. You do start to even see the second tail of Google searches where they may be searching for the hashtag or campaign element start to support your thinking. The downside of that is that those channels that we celebrate success with, like, yeah, woohoo, cost per lead is looking great, and I've got all these folks in the front door, that has to translate into business. And so many times, I've made this mistake personally, is you get a campaign out and you think it lands and you think that stuff's coming through the door, and there may be limitations in your funnel that you haven't thought through. There may be second level messaging challenges that you haven't thought through. And I know Carlos runs a newsletter about free toasters, I think. And one of the best bank campaigns I ever had was like, okay, banks give away toasters, right? So we're going to give away this supercharged $300 high-end toaster. And we're going to fulfill it online for customers who are coming through for a checking account with these criteria. And it was the easiest sell I ever had at a bank boardroom. Everybody thought it was great. Nobody batted an eye at the cost of the toaster. The lead gen looked fantastic. We turned that thing on from connected TV to ad spend to what have you. And the leads were piling up and we're like, this is great. It was something like 100 leads for even one conversion over a month. And it was, sequentially, it was terrible in terms of performance. So that's a case where our leading indicators didn't tell the full story of the funnel, but more importantly, we were operating so far outside of consumer expectations with message that we couldn't have coached those folks to complete the funnel just for a toaster, no matter what our messaging had been. So that's where I've seen some real positives and negatives to KPIs like that. Is like, when you've landed a message, but then the real work starts, and how does your experience translate that into your business goals?
I'm open for the toasters. It sounds like you might have a backlog of them. You weren't able to push them. So
we did pay for performance, so we didn't get on the hook or anything like
Very
that.
But
good. It was amazing. Like, there was everybody in the market, right, telling you, this is so cool, but not cool enough for me to actually change banks or go through the hoops or even complete the lead gen funnel.
So Amanda, we talked about, focusing too much on application volume or too much on the cost per lead. And, you overlook maybe lead quality. What signals tell you a channel is bringing in customers who are actually valuable?
Yeah, I mean, we've kind of touched on this a little bit already, and how that top of funnel metric is not always an important one. It's what's the quality within that number, right? You could bring in 100 and only 2 of those people matter to you. I think the key is understanding what's the intention and what's the goal of each channel. And even like in the affiliate space, what is the goal of that partner? What are they trying to bring in, and how do they solve for their own goals? So like every affiliate, uses a different strategy. Some use an authenticated login experience. That's a different intention in how you're going to market to consumers than if you are specifically building content to put into SEO that drives a different type of engagement on your site. So just understanding that first helps to understand what's going on, right? Like there could be a surge because affiliates have a budget that they need for the end of the quarter. So how do they get more by the end of the quarter? Within that, I think once you've gotten those leads, it's what happens post-application, as we've talked about. Like it's how is that application fitting your desired buy box? Is it driving to conversion? Do you have blockers in your funnel that you're not marketing them right? Are they getting stuck somewhere? So it's really like an all-encompassing focus, I would say, across end to end of the funnel, like understanding how those leads are maybe coming to your third party or even to you. What is their intention? What's your intention for them? But how do you then predict their downstream behavior based on that top of funnel? And does it fit to your buy box and your long-term strategic goals?
What I'm hearing throughout is that, you really need to have a good view from top to bottom of your funnel. And so moving into attribution, how does weak or incomplete attribution lead teams to overvalue the wrong channels or underinvest in the right ones?
Yeah, I see this one all the time, Danielle. I tend to jump in. Lenders are looking for help with affiliate marketing, but then as you kind of get into the details, you start to see how everything connects with everything. But I guess as far as incomplete attribution, what I've seen over the years is the higher up you go in the funnel. So like in the old days, it was like TV, radio, billboards, things like that. These days, it's like YouTube, podcast, newsletter, things that are trying to get high level awareness. The CACs on dashboards look horrible for those kinds of channels. Sometimes they look infinite. It's like, oh, I don't know if this thing produced a conversion at all, right? And I learned this lesson. I was at a Fortune 500 company earlier in my career. I was running like direct mail and digital. Like I was at the bottom. I was like optimizing bottom of funnel channels. But the company I was at was like completely world class at branding, right? They were running all sorts of stuff all over the place so that when my stuff went into the mail, people recognized the logo and the brand and the products. So of course my conversion rates were amazing. It almost didn't matter what the hell I said on the letter because the brand team had done the hard work. And then I was like high-fiving with my analyst, colleagues thinking we're geniuses. And then I leave that setting and then I'm in fintechs or I'm an entrepreneur, I'm doing my own thing. And I do the same direct response campaigns that worked over there and the crickets, like no one responds. And eventually I figured out, okay, it's the branding that made all the difference on the conversion level. I think as a general principle, I find that to be true. One really tactical example, this comes up a lot in the work I do with clients, is that direct mail tends to be undervalued. The reason I think that happens is because it's a branding channel and a direct response channel all at once. So some people will pick up the mail and convert straight through the link or the QR code or whatever. And some people will sit there and say, oh, that PNC offer I got last month, I want to learn more about that. And then they end up on Credit Karma or they end up in like a search ad or whatever. And then that last channel internally looks like it did all the hard work. But that customer wouldn't have been on the market for that product had the letter not landed. So I always encourage my clients to look at their DM lists. Who did they mail? And who's coming in on the last mile through paid search or paid social or affiliates? Because you need to start giving at least some partial attribution to direct mail. I found that to be the case. But lenders that look for just that really clean linear connection between mail and results sometimes underinvest in that channel. And actually sometimes even shut it down because they conclude it doesn't work anymore. But it's 2026 and I still see mail doing billions of dollars per year in this category. So I don't think it's going anywhere.
Interesting.
Totally right on direct mail, and banks love direct mail because they understand it. They understand what it costs to produce a printed piece and get it in the mail. And the challenge is exactly what Carlos said. They may pull out of it after 30 days, seeing that, well, we spent this bulk in postage and print and creative and only have this. And they will pivot even before 2 months or 3 drops or what have you. And in the reality, it's doing the two things that Carla suggests. It's branding and a call to action. And if you have any sort of additive digital media around that direct mail, and you can argue and attribute during a time horizon that's decent, you can really see the messaging and the ROI take shape, because even a CTV campaign on top of a direct mail often will double that conversion rate for direct mail. That's a challenge for banks oftentimes too, is the conversion rate on paid search versus direct mail, and then your other conversion rate of getting somebody to actually fulfill and fund an account is far downstream and takes often strategic sessions to walk through.
And I think one more thing to add to that is, like, especially with direct mail, sometimes you're planning the next campaign before that first campaign is even dropped in the mailboxes. So you have to make decisions on no information, and it just takes time, and you have to be committed to that. Like, you have to commit the time horizon for that to really get the learnings, to have it build and understand how are those consumers leveraging that paper when it finally gets to them.
That is really interesting, because this Cornerstone report, one of the questions asked the 126 marketing execs to list of the channels that were listed, how they perceived their value across 4 attributes. And direct mail was actually rated on average last, tied with CTV. And that tells me maybe that's because the time horizon was not there. The patience, the coordinated strategy across other channels, or how they're measuring it alongside other campaigns, wasn't there. So maybe that's why it got such a low score. Very interesting. I had a question pop up. We talk about, Carlos, you mentioned brand awareness and how it pulled so much weight, the branding and the really strong work that's done there. I often, on the flip side, understand when, marketers just cite brand awareness as the objective when they maybe don't know more directly what the outcomes may have been. So it's this push and pull of branding is really important, and sometimes it's kind of just the throwaway of the objective of the campaign. So maybe my question is, does brand awareness get too much credit, or maybe not enough credit when we're speaking about ROI?
I'll speak for the segment I serve most,
Sure.
which is in the fintech world. So I generally don't advise the Fortune 500s. It's the fintechs that come to me for the most part. And I think they grossly undervalue brand. Grossly undervalue. Like, to the point where the most common thing I see is 0 brand dollars being invested outside of direct mail. So no TV, no podcast, nothing, no billboards. It's arbitrage stuff. It's, I spend $1 in affiliates or in search or in Meta, hoping to get $2 back, what I think is tomorrow. It's very arbitrage oriented. And I think they miss what, like the SoFis of the world, I think, understand this. They're a fintech that has stadiums, and they invest quite a bit in their brand. And they're very thoughtful in connecting what's going on top of funnel to results downstream. But my observation in the fintech world is that they should be investing more in brand, and that they fail to do so because the attribution isn't as clean.
Yeah, and I would say from a banking standpoint, man, bankers do not want brand to exist as a thing. They just don't. They want to be able to spend that $1 in paid search and have $1.20 come back. But it's the truth of the matter that the more you invest in brand, the less you have to do in affiliate or search or name your channel. The reality is it's a struggle to measure. And so most marketing teams, CMOs, agencies, banks really struggle to quantify brand awareness because it takes sometimes years, months, whether it's deposit market share or customer surveys. That's a lot of legwork to determine your branding. So as a CMO, if you can figure out a way to present to your clients the importance of brand awareness, and for me, I always say you do the branding so that you can make the ask, and then you try and quantify that in some way. The reason SoFi is successful is because they are out everywhere, not always asking for the business until you get into the direct performance channels. And that type of push and pull is really effective for banks. The question is, how much do you devote to brand awareness versus affiliate versus other performance channels? And that's up to you and your institution to determine your key performance indicators and your investment and return level.
There's one more thing I wanted to add to that, because John's really hitting a good point here, is like, it's a split of how do you split that brand awareness budget versus actual acquisition budget. And so much of it goes to that acquisition budget. Then you get questions of why aren't people converting? But maybe you're trying to acquire them when they aren't ready for the product you're pushing them. And so investing that money in the brand keeps you top of mind to them. And then in 6 months, when maybe they are ready for that product you want them to take, they remember because they saw you 3 times walking past a billboard to the train station. Like, it's a balance of trying to get to that consumer when they actually need the product you're pushing.
I mean, from an affiliate standpoint, I can't tell you how many conversations I've had where, banks or fintechs will approach us and say, so affiliate marketing can do it all, right? But if we give you all of the budget, it's a full funnel channel, can't you? And yes, it's a full funnel channel, but it cannot operate in a vacuum. And it's not a silver bullet, and it can't. You need, exactly to your point, you need that brand to be able to help the pull through affiliates. So I resonate. I want to take that sound bite and share it everywhere. I guess.
Actually, Danielle, one point there,
Please.
You reminded me. I think this one's interesting for lenders that are maybe early in their life cycle. It connects to branding, but when you don't have an established brand of your own, drafting off of your partner's brand is actually mission critical. So like if you can get listed on an Experian or a Credit Karma or a Lending Tree, a platform that has an established brand, now you're basically, what the consumer is saying is, I trust so and such fintech I've never heard of because I trust the publisher. Mm. So in early days, being listed in affiliates is actually a way to build your brand, but that can only get you so far. If you want to get into, the top echelons of your group, you're going to have to develop your own brand eventually. But in the early years, I've seen that be effective.
Brilliant. Thank you. There's a question in the Q&A. So now's the time, folks, if you want to pop in any questions. How do you push back when leadership is personally attached to a channel that isn't performing?
Good luck first.
Plus one.
Yep.
I think the reality is everybody's got their pet channels. And, sometimes in banking, those channels can be the names on stadiums, and you've done the work, you've measured, you figured out that something isn't working, no matter what it is, and it is hard to pivot off of that. What I've always done, if that's the case, is not necessarily argue for an A and B test, but figure out how to pivot enough resources into if my client likes, AM radio versus FM radio, I'm going to start at some point leaving AM alone and starting to increase or experiment with FM, and then looking downstream or back at the office at what those customers have actually delivered if I can. And the reality is you probably have to live with the sacred cow for a while before you can pivot resources away from it. The goal for you as a CMO in that standpoint, what I would do is make sure I have enough budget to allocate to other resources as well, whether it's total comparison or whether it's just to drive the business.
Yeah, and another one I'd offer is consider, if you've been fighting the battle yourself for a little while, a quarter or two, consider a different voice in that conversation, whether it be some external stakeholder or an outside consultant, someone that's not you. Literally, sometimes that makes the difference, because folks can get wedded to their opinions within the context of a relationship, particularly when it's a subordinate relationship. versus a senior leader may hear it differently coming from the board or from an outside consultant or what have you. So I would just try landing the message, not only in different ways, but from different people.
That's the power of affiliates. If we're bringing it back, it's a third party validation, right? Well, that's time for us. Thanks, panelists. You were wonderful. Thank you for your insights. For everyone who tuned in, thank you so much for joining. We hope that you were able to take away some really good nuggets. There will be a recording of this that's emailed to you if you've registered. So look out for that. And we can also email the Marketing ROI report if you're interested. Thanks for your time, everybody. It was a pleasure.
Thanks for having
us.
Thank you.
This is a quick plug here for my marketing agency. It's called New Market Growth. We do nothing but help fintech lenders accelerate their growth in affiliate marketing channels. Our services are both strategic and operational. And if you want to learn more about how we can help you, find us at newmarketgrowth.com or email me directly at carlos@newmarketgrowth.com. If you want to support the show, the number one thing you can do is go to thefreetoaster.com and sign up for our newsletter. You're going to get a couple pieces per week of news, information, insights, and podcasts like the one you're listening to right now at the intersection of marketing, lending, and technology. That's our niche. We don't plan to go outside of that. It's the only publication I've seen out there on the internet that dials into this zone. So if you want to support us, sign up and share it in your favorite Slack channel.